So let's take a look at that market reaction and we turn to Liz Young, SoFi's head of investment strategy. So Liz, as obviously the markets have a lot of information to digest and they're wondering how the Fed is going to react to these different data points as well, what is this doing for investor sentiment right now?
Investor sentiment is pretty extended on the bearish side, and it seems difficult to find really a lot of positivity in that. And you can look at that a couple different ways. You can look at it as there isn't much to grasp onto as far as looking forward and getting positive about a soft landing. Or you can say that when things get this extreme on the bearish side, we're getting closer and closer to that being over. Now, what we're still dealing with, though, as you've clearly pointed out, is that there are a ton of data points rolling in, many of which are telling us that the economy is softening, things are slowing, but it still hasn't been enough to fight that big enemy, which is inflation. So it keeps the Fed on this path. The jobs numbers from last week keep the Fed on this path, and that's what the market is really grappling with.
Liz, what do you think has been priced in, not priced into the market at this point when it comes to Fed policy, the likelihood of a recession? What has been accounted for?
So if you look at just the movement in what the market expects the terminal rate to be, so the rate at which the Fed will stop hiking and either pause or have to eventually cut, that rate has actually moved up, or that expectation has moved up just even in the last week. We're looking at about 4.7% terminal rate as expected by the market by March of next year. So you could assume that that's sort of what's priced in, but you're still looking at the expectation of a recession still only about 50-50. And with a market that's been down at most 25% peak to trough this year, it would tell me that we still have further to go on the downside to really price in a recession. And that could be what we see through October. As we start to get earnings information, if companies start to revise down, and as economic data continues to soften, we could get closer and closer to that 30%, 35% down, which would effectively price in a recession, in my opinion.
Speaking of, Rachelle mentioned off the top the prediction from Jamie Dimon, 6 to 9 months before we're tipped into a recession, that Europe is already there and that our markets could have another 20% to fall. Your thoughts on the latest comments from Jamie?
So, look, it's not necessarily new that he's said that he's worried about economic growth. So it's not the first time that he's mentioned this, but it's definitely possible. And, even 6 to 9 months seems a little far out to me. I think that if we do see a recession or the beginning of one, that it'll happen in the first half of 2023. As far as another 20% down in the market, that feels like a lot to me. And look, nobody really knows how much further it could go and where the stopping point is. But 20% more does feel like a lot to me. And if you just think about, on average, to price in a recession or a drawdown during a recession, you do have to get beyond 30%, and we haven't quite gotten there yet. So at this point, the market is still sort of hoping that we can avert one. I don't know that we need to go down another 20%. I feel like 3,300 on the S&P is a pretty good stopping point, if not beyond where we might stop. But again, who knows what the future holds? There's a lot of different things that could happen. And one of the things that I think investors should really be watching is credit spreads. There hasn't been a huge blowout in spreads. They've widened, but in a really orderly fashion so far. If credit spreads start to become more troublesome and get to a level where we're worried about defaults, particularly in the corporate market or in consumer lending, that's when you have to start assuming that the stock market will go down much further.
So then, Liz, given those factors, then a lot of investors, especially retail investors, wondering, should I hold on to my cash? Is that the safer bet versus, say, other opportunities? What are you seeing in terms of opportunities here? What's the play here, short term versus longer term?
So in the short term, look, it's not a bad idea to hold on to your cash if you're nervous. But here's what I would say. We've already done a lot of work on the valuation side. So we've done a lot of re-rating in stocks. Like I said before, we've gone down at one point from peak to trough 25% in the S&P. So if things continue to fall, it's okay to start thinking about buying that incrementally on the way down. And you can look at many people are talking about a barbell approach. I do think that that's a good approach. So on one end of the barbell, you've got safety stocks, which are pretty expensive right now, and I would keep that in mind. But you can also think about putting things in there like gold. You can think about using treasuries at this level. And then on the other end of the barbell, look at some of those growthier names or some of those cyclical sectors that are probably trading at pretty attractive valuations compared to where they were a year and a half, 2 years ago. So thinking about just entering into those names systematically, don't spend it all at once, but systematically as we go down. And always remember, the market bottoms before the economy bottoms. So by the time the market is done with its downdraft, the economy still has to follow. And by the time the economy bottoms, the market usually has started to recover.
Well, Liz, what you're saying right now about those growthier, more cyclical names brings me to tech and the selling that we're seeing today, and really what we've seen since the start of the year. Clearly, we have seen a large drop in valuations. The selling that we're seeing today, though, bringing the NASDAQ to its lowest level that we've seen in more than 2 years. I guess, what do you think it's going to take to get investors back on board? Or if they are picking some of those growthier names, those cyclical plays, what more specifically should they be looking for?
So one of the things that you covered earlier in the show was semiconductors. And what I would say to people about that, it's important to think about this. The way that the economy has changed and the things that the U.S. economy is now dependent on are much more technology focused. So semiconductors have really taken over as one of those cyclical indicators in the tech space. So on a day where we're having increased recession fear and we're still worried about the Fed raising rates too far and putting us into a recession, it is probably not any surprise that semiconductors are under a lot of pressure because they are that cyclical indicator for tech. Now, as they continue to get hurt and as we see recession fears heat up, as the market prices that in, that's when those names start to become attractive. So I would still be waiting a little bit and maybe even beyond when the S&P gets lower than 3,500 if that's the case. But that's when you start to nibble on some of those names. But you want to be choosy about it and make sure that you've diversified your portfolio still outside of tech because rates are going to stay high for quite a period of time here until inflation is under control, which means that technology, communications, and even some consumer discretionary names could have a lid on their upside because of that rate hike. But you can start to enter back into what I would call the sort of cream of the crop in each of those groups.
All right, well, certainly some great options there. Big thank you to Liz Young from SoFi. Thank you for joining us this afternoon.